I think gold will become money again. So you won't really sell gold. You will exchange it for assets. That's the way I see it. Or we could see it going 1-to-1 by 2027. And then by 2031, it could be at 0.5-to-1. So that's the bigger picture there. I really think, having done technical analysis all my working life and fundamental analysis, I think this chart is breaking down, and we're going to see gold outperform the Dow. At what level will the Dow and gold be when it's 1-to-1? I don't know. It doesn't really matter. It's all relative. It could be 100,000 each, or it could be 2,000.
Gold prices are experiencing a bit of a dip for the second consecutive day on Monday, currently hovering just above the pivotal support levels of $3,265 to $3,260 during the early European trading session. Analyst Mario Innecco notes that gold is trading at around $3,282, with fluctuations between a low of $3,267 and a high of $3,337, but he remains optimistic and reassured about these short-term shifts. On a brighter note, silver shows more resilience than gold. Gold was trading just 18 cents lower at $3,290. Its low was $3,263, and its high was $3,321. As reported by FXStreet, silver stands at $33.02 per troy ounce, reflecting a slight decrease of 0.23% from Friday's price of $33.09. Looking ahead, Mario highlights an intriguing forecast from Dohmen, who predicts a remarkable 31-year bull market in gold that began around 2000 and is expected to stretch until 2031. While he anticipates that the key turning point may not land exactly in 2027, he emphasizes that, like many natural cycles, they tend to have a broad range of accuracy. This encouraging outlook aligns well with gold's recent impressive performance, witnessing nearly a 30% increase since January 2024. Mario believes that the ongoing geopolitical and economic uncertainty may continue to drive this upward trend in line with the long-term cycle. While he notes potential challenges from fewer rate cuts and a stronger US dollar, he is confident that gold's fundamentals still shine brightly as we navigate these exciting times in the market. Before we dive deeper into the video, make sure to subscribe to our channel, hit the bell icon so you never miss any updates, and share it with friends and anyone who might benefit from it.
If you measure 1933 to 1980, that's like 47 years, and you add 47 years to 1980, you get 2027. So I don't think there's much time left for people to protect their credit investments, stocks and bonds. And how do you do that? Well, you have a little bit of gold, or you have a lot of gold. It depends. Or you have no gold if you're fine with having your wealth decimated in terms of purchasing power. That's up to you. But I would add a little caveat to this, is that I've watched Bert Dohmen, who was around in the late 70s and the 1980 bull market in gold. And back then he said, in 1980, when everyone was very bullish and the crowd and the public was getting involved, he said, well, we're now in a bear market, and it's going to last until, 20 years, 2000. And that's exactly what happened. And then he said back in 1980 that after the year 2000, there would be a 31-year bull market in gold. So you add 2000 to 31, you get 2031. And that's why I think, it might be a little later than 2027. Cycles, like nature, are not always perfect. They are fairly exact, but be prepared. And if we do get to 1-to-1 or even less than 1-to-1, and it's 2027, I would say that could be the top for gold. But this time around, I think gold will become money again. So you won't really sell gold. You will exchange it for assets. That's the way I see it. Or we could see it going 1-to-1 by 2027, and then by 2031, it could be at 0.5-to-1. So that's the bigger picture there. I really think, having done technical analysis all my working life and fundamental analysis, I think this chart is breaking down, and we're going to see gold outperform the Dow. At what level will the Dow and gold be when it's 1-to-1? I don't know. It doesn't really matter. It's all relative. It could be 100,000 each, or it could be 2000. Even if it's at 2000, if you've got gold, you've done really well. It's all relative. So there you go. Let's quickly look at where the markets are this morning. 8:32 a.m. London time. A lot of volatility in gold still. We're at 32.82. Low's been 67. The high's been 33.37. So not concerned, of course. This is short-term moves. Silver's down 18 cents. So it's outperforming gold slightly here. It's at 32.90. The low's been 63. The high's 33.21. The Dow futures is down 56 points. NASDAQ down 26. S&P is only down 8.
Mario explains that the markets naturally corrected the excesses from the World War I credit bubble. However, the correction didn't reach the previous low, indicating it was still part of the same bubble. The roaring 1920s then marked the largest credit bubble up to that point, with the Dow-gold ratio nearing 20-1. Since gold was still money, the Dow would have reached nearly 400 if the ounce price of gold, $67, was multiplied by 19th. In the 1900s, the Dow-gold ratio generally fluctuated, serving as a key indicator of relative value between equities and precious metals. In 1918, the ratio was around 3, meaning it took 3 ounces of gold to buy the Dow Jones Index. This measurement provides insight into how investors value stocks relative to the monetary metal during different economic periods. The dramatic changes in ratios throughout the century reflected major economic shifts and monetary policy decisions. During the Great Depression of the 1930s, the ratio fell below 3 as stock values collapsed while gold maintained its perceived safety value. Similarly, during the inflationary crisis of the 1970s leading into the 1980s, the ratio again dropped below 3, highlighting gold's traditional role as an inflation hedge when equities struggle. Let's get back to the video.
We're going to start with the credit boom that we saw after World War I. It started pretty much, let's say, it actually started with the outbreak of the war in 1914, as you can see here. That ratio was around 2.5. Yes, it came back down in 1921. There was a short-lived depression that didn't last very long. Why didn't that depression last very long? Well, because the government and the Fed hadn't learned about interfering in the markets. So the markets cleansed the excesses of the previous credit bubble from the start of World War I. But you notice that correction didn't go back to the low from World War I. So it's still part of the same World War I bubble. And then you had the roaring 20s, of course, and that was the biggest credit bubble up until then, of course, as the Dow gold ratio went to almost 20-1, as you can see here, is about 19. It might have been higher on a daily or weekly basis. This is a monthly chart. And back then, of course, gold was money. So that means that the Dow almost got up to like 400. The ounce of gold was $20.67. If you multiply that by 19, you get to just under 400. But then, of course, we had the stock market crash of 1929, and that pricked the credit bubble. Didn't necessarily cause it, and who knows why it happened. Well, I think it happened because credit bubbles and the excesses don't last forever. Just like if you go out to a party and you drink a lot, there's going to be a point where you either stop or you pass out. And that's the same thing with the credit cycle. And then we had, of course, the Great Depression. It was really vicious. Again, they try to intervene, actually, contrary to popular opinion. Herbert Hoover did intervene a lot. The U.S. government bailed out a lot of institutions. They borrowed a lot, and the Fed started helping, actually, even though it wasn't supposed to. They weren't supposed to buy government bonds, but retroactively in 1935, they changed the rules or the law. But be as it may, as the Dow collapsed, this ratio dropped. And back then, of course, it was just a normal Dow. People didn't look at the Dow gold ratio because up until March 1933, which was when coincidentally this ratio bottomed, Gold was money, so there's no such thing as Dow gold ratio. There's just the price of the Dow. But yeah, it bottomed at around 2. I've got here, let's see, the exact low from March. Yeah, actually it says 1.9, so just below 2. So that means that, yeah, the Dow was worth about 40 after being worth almost 400. So it was a vicious correction. And that was the first reset, 1933. Remember that date. And then up until February 1966, excuse me, there was a credit boom. Things picked up again. Yes, you had the war in between. You had the New Deal and everything else. But then it topped. And this time it topped higher. It topped, around 28.
Gold and silver have shown remarkable strength as reliable stores of wealth, frequently shining brighter than stocks during challenging economic times. Despite the ups and downs of the Dow-gold ratio, these precious metals have steadfastly held their ground as solid forms of money, offering much-needed stability during market corrections. Their enduring significance in safeguarding wealth, especially in uncertain times, is truly impressive. Do you believe gold and silver remain the top hedges against inflation today? Drop your thoughts in the comments below. If you found this video insightful, don't forget to like, subscribe, and hit the bell icon for more updates. Thanks for watching.